but awesome. I mean, we're going to go over a lot of these topics as well, I see here. So great stuff. And it looks like we're already here at 4 p.m. Eastern. So we'll go ahead and get started. And for those that are not as much aware of Carla and I, so we run Cycle CPA. It's a virtual accounting firm. So we have a fully remote team, and we specifically serve a couple hundred companies in the green industry throughout the country. So that's really our focus here. And our goal, with a lot of this stuff that we do in regard to the webinars, is we want to really create a situation where, you all are not learning the hard way with as many things as possible as you're growing and scaling your companies, and, trying to give you this perspective. But I think it's phenomenal that so many of you have, come here, and we had over 400 people register for this. So, I think it's fantastic stuff.
Yeah, I know. That's great. I love to see people looking to advance and look for opportunities within their green industry businesses. And yeah, for those that don't know me, my name is Carla Policastro. I'm one of the CPAs at the company here. And like Joe said, our passion is working with green industry businesses. And so we're going to share our knowledge along the way here.
Awesome. So we really do believe that you can utilize your accounting and financial side of your business as a competitive advantage. And I think that's going to be one of the themes here in today's webinar. And part of that is, it's thinking about scaling and growing your company. Of course, it's great to be able to generate revenue, and that's going to allow you to make a lot of different moves in your company as you're hiring and investing into different aspects of the company. But one of the biggest things as you scale is you ultimately want to be in the position where you're looking at the bottom line, right? So bottom line meaning maybe net margin, and then even more specifically, understanding, okay, what is our direct labor percentage? What is our gross margin? Even on the balance sheet side, what is the return on fixed assets, right? So it's thinking about, going from managing things based on revenue and growth and maybe what your bank balance is looking like versus narrowing down into the financials, because that's how you're going to end up being able to reinvest back into your company and continue to grow as well.
Yeah, and sometimes I think as business owners, we're very driven by the numbers, right? But sometimes, or by goals and milestones, and that's why you're in entrepreneurship. But our goal is to say, yes, it's nice to have those goalposts in mind, those milestones in mind, but let's look at some of these metrics here that you really should be making decisions off of, and not top line revenue, right? And we're just having a discussion with a business owner this week, and they're scaling at a good rate, but they're not scaling profitably. And we want all companies to scale profitably, right? Because you may think, yeah, I'm growing, I'm in this growth phase, I'm going to make more money in the future, I'm going to get a return, and that might be okay for some time. But if you keep scaling at that rate, you're just going to keep scaling that model that you're in that may not be profitable, if that makes sense. So you want to keep your eye on these certain metrics as you grow the company to make sure that you're on track.
And a lot of it comes down to capacity as well, right? And starting with overhead costs, and one of the things here is, you want to make sure that you're basing certain overhead investments, and as you're hiring, whether it's overhead staff or administrative staff, that they're truly needed within the operations, even after you've looked into maybe certain process improvements and technology and software, right? and always thinking twice before you're adding any overhead expense, because they're not directly generating any revenue for the company. And one of the aspects too is the faster your company's growing, especially as you're thinking about your 2026 goal, the faster your company grows, the more active you're going to have to be in regard to potentially hiring people a little bit earlier, or I should say, you're going to be taking on people even before you have maybe certain revenue marks that are already hit. So it could add a little bit more risk to overhiring, right? If a company is only looking to grow by a couple 100,000, there's only so much risk involved with that versus maybe $1 million or $2 million that they're looking to add next year. There's a little bit more risk if you don't hit those targets. And what can help with this is staying close to some of the leading indicators. So leading indicator, that's something that you can look at as a leader within your company, which is going to give you more of an early sign into what the potential outcome, maybe it's financially, what that outcome will be. So for instance, if you're looking at client churn, if you see that increasing with some of your, maybe you have a lot of maintenance customers but you're seeing a little bit too much churn, that's a great leading indicator to potential changes in revenue that are going to happen, right? So another example is the sales pipeline. Maybe you're not seeing as many customers, looking for certain projects to be done. So as you're scaling your company, if you're in the position where, okay, I want to double next year, and if you have clear data, you have your sales pipeline, and you have a good understanding of, okay, this is the amount of employees I typically have. Let's say if I churn 15% next year, I have the recruiting systems and the operations in order to support that already in place. Maybe it's on the sales side. How confident are you that you're going to be able to hit those sales goals based on the different systems that you have on the marketing and the sales side? The more confidence that you have in those systems, the better predictability you'll have regarding building out some of the capacity plan, because being off with the capacity plan is going to have a direct impact on your profitability, right? If you're over hiring, or even on the other side of it, if you're under hiring, right? If you're not taking on, there's some opportunity that you may not be able to take advantage of. Also, the potential burnout and maybe the not so good experience that it could be for some of the customers, right? As you're maybe a little bit understaffed. So again, it's trying to get the best data within your company so that you can make the most accurate decisions regarding some of the capacity within your company.
Yeah, and somebody in the chat says, well, how do you do that? The client churn could be monitored on your CRM that you have, your planning system. You can probably change a label on a client, says client canceled or something like that, right? And that should be tracked on your CRM so you can see, okay, how many clients maintenance clients, or did you start the year off with, and how many did you lose, right? And that you should be able to calculate the percentage. And then employee churn, obviously you would know how many people you hired versus how many you lose. And then your sales pipeline through either your CRM or just a sales CRM. But somebody emailed us earlier last week, I think it was. They said that they had a concern because they couldn't keep like an employee for more than a year. Like they just kept losing employees. And I think that, if you're continually losing employees, then what is the hidden cost of that, right? There are hidden costs, because maybe it took you like 4 to 6 months to train that employee, so they weren't fully at capacity or efficient, right? So that means the salaries and wages you were paying for wasn't fully like generating the revenue that you were expect for them to generate, right, at that time. And so there are different approaches in how to handle employee churn, whether it's giving those employees more training and development, giving them more opportunities, or if you get a really good employee and within the first few months, like this person's a go-getter, like creating those opportunities for them, but maybe even giving them a salary increase or a bonus. Like if you know that this employee is a really good employee, that may be worth it, right, in order to keep them on. So those are just some of the things that I would look out for, because that directly also affects your client experience. If you're always having to get new employees that need to be trained up and then are not performing the job correctly with your clients because you're always having new employees that need to be retrained, if that makes sense.
Absolutely. And for companies, whether you're starting out and looking to scale your model, maybe past a solo operator, or you're a company maybe doing 5 million in sales, looking to scale into different branches, you want to be able to understand, okay, what are those different business units that have reached profitability, that it's a proven system, it's a proven setup, then that's the point then that you continue to scale. And there's a couple of reasons why. One being that you can actually take some of those funds in regard to profitability that you make from that first business unit or maybe service line or branch and utilize that to also start that other service line or branch. The other reason as well is, when you scale, and we're going to dive a lot into cash flow as well, but oftentimes cash flow, although you grow the company more, it doesn't necessarily have a direct relationship with cash flow. Cash flow could actually go in the opposite direction. So it could get worse. So, those are some key reasons why as well. One of the other more common things that we see, and again, going back to some of those reasons why we hold these kind of webinars, is we want companies to not make the same mistakes that maybe we see sometimes, right? And, one of those is, I think it's sometimes as a company, if you add $500,000 in sales and you think about, oh, okay, maybe it shouldn't be that much more to maybe add $1 million in sales next year. But let's say if you're $1 million company, up until that point, you were really the only leader that the company needed, right? So although you're just adding maybe another $1 million on top of that to reach a $2 million goal for next year, that may actually mean that half the company is not actually under your direct leadership, right? Maybe because it's in a different location, maybe because it's a different expertise. So keeping that in mind and understanding that oftentimes there are certain inefficiencies and, some negative aspects to that. And as you scale and, maybe it's not going to be under your direct leadership and oversight in the field, that's why it's important to create those systems up front, especially before you scale and kind of multiply whatever model you are using. I think that's an important note here as well. And part of profitability is, especially as we're entering the end of the year, you want to understand, what did we do right this year, right? What are things that we did well, but on the other side of it, understanding what did we not do well, right? And so you might have multiple crews, right? And one of the crews may not be doing something as well as maybe some of the others. And that may just be because some of the other crews haven't even experienced that specific situation. But the whole goal is that you take whatever negative thing happened to that one individual or that one crew, and you create an SOP, standard operating procedure, around it, so that ultimately you're preventing that from happening as the company scales, or just in general to those other crews, right? So, and ultimately what little things like this turn into over time is you're really covering up a lot of those areas that inefficiencies can fall within, and thus leading to unprofitable periods. as well. So it's in an example, maybe there was a little bit excess of materials that were purchased, right? So it's kind of building in. Okay, can we build in more of something where there's maybe more than one person to approve the specific purchases? Building into the job costing and checking that maybe on a weekly basis, and then adding that as an SOP, whether it's in the workflows or within the databases within the company. And then even in the initial training process, right? So, these are all things, as you kind of think about all aspects of the company that you can really work on over time. And oftentimes as companies have goals, one of the biggest things that we see is a company might have a great goal, but then one thing happens to their company. There's one tweak, and that actually prevents the whole operation from really excelling, right? So we're going to dive into more of the perspective in regard to the contingency planning. And the more proactive you can be, the better position you'll be in. And what does this look like? So as an example, maybe instead of just relying on subcontractors, you can actually blend it with some full-time W-2 staff as well, right? To protect that downside, to kind of diversify in that sense. Maybe also, look at multiple vendors. Even though you use one material vendor, maybe you should look into some others as well to kind of hedge against, if something happens with that one supplier. Also looking at, based on seasonality, looking at the service lines, what does that look like in regard to, if something happens in that specific season. So always thinking about, okay, what happens if things don't go as planned, right? And what can we implement because of that? And get very specific too. Think about different people in your company. What'll happen if this person leaves? What'll happen if we actually are taking 15% less customers? What happens if certain costs go up? How are we going to react to that? And think about those specific plans. That way, instead of being more in a situation of fear, if we lose this person, if this happens in our market, if that does happen, you have a strategy that you can work on almost immediately, where you can start to tackle that. Because the reality is that business is not perfect. A lot of it becomes kind of rolling with the punches, or just kind of understanding how to react to certain things that come up. And sometimes the challenges companies face in regard to scaling doesn't have as much to do with a lot of the intricacies of how the team is doing, and certain other aspects of the operation. It actually might be due to other factors, more perspective of, when you're receiving the cash and, how that's impacting your margins as well. And here's some key examples to that. And this is something that we run across often, and often this is something that even prevents companies from scaling. Maybe they're too heavily relying on some commercial maintenance, let's say, right? And really what that's doing is that's putting a bottleneck on them being able to scale and reinvest back into equipment and the right people in order to scale. So because of that, maybe they have a more of a higher end residential install-based division that they can rely on to help cover payroll and help if that growth. Also looking at within this industry, as I mentioned briefly before, looking at the seasonality. If that is more of the bottleneck, then it doesn't have as much to do with maybe growing the division that you're doing great in, right? Because that division might have a a worse impact on cash flow, maybe it's actually implementing something that balances out the seasonality. That's actually going to enable you to continue to grow. You know, there's some companies where they have maintenance divisions in warmer climates, and they might do snow plowing up north because that's what enables them to continue to scale. Maybe it's looking at the contract duration, or in situations where some of your crew and equipment can be used in multiple divisions. Not only does that help to utilize a lot of the equipment better, but it also puts you in the position where people can shift and be flexible if different things come up in the business, right? So these are all things, again, as you think about building out some of those scenarios in regard to some of the contingencies, these are ways that you can react, and instead of being surprised, try to be proactive and think ahead. What can happen and how we're going to react to that. Even if as the owner, you have to get a little bit more involved for that next month or two within that specific item. So again, these are all things to think about, as you're thinking about risk, moving into next year. And as many of the cash flow is definitely something to focus on, right? And this is the reality of why some companies don't really see it as worth it to maybe continue on, because sometimes the work may not be worth the amount of positive direction your business bank account's going in. So making sure that you have that cash on hand, a few months of operating costs. Get a line of credit before you need it, right? So be a little bit more proactive in regard to that. Make sure you're not taking too much money out of the company, right? So keep the owner's distributions in check, and also thinking about forecasting the cash flow as well, right? Which we're going to get into here too.
Yeah, and you guys know, like, I'm a big believer in maintaining some sort of a cash flow forecast, even if it's very basic, because again, as a business owner, you may be relying on your bank account balance. And what is your bank account balance today telling you about your business? Really nothing. It's not telling you anything, because it's a bank account balance that is just a snapshot of the day. It's not telling you what your upcoming bills are that are needed to be paid out, or your incoming revenues that are coming into the business. And so you want to use a forecast to plan out the money that's coming into the business, the money that's leaving the business, and giving you a little bit of an estimate of what your cash balance is going to look like. And again, it's super important, even if you run a seasonable business, even more important to have a cash flow forecast, right? I think every business should have one, but if you have a seasonal business, I don't know how you can run one without this, because you may need to pull on a line of credit, because maybe it's your business model, right, that you are slower during the winter time, and that's okay. There are cyclical business models that have that sort of cycle. It's fine. But you may not feel confident enough to pull on your line of credit and to feel that you can repay it back. But, that's why having a plan is important, because you'll be able to see that, right? That you may be able to pull on your line of credit during the winter and then pay it back during the busy time, right? And that may be fine. But you won't know that unless you have a forecast in play.
So now we're going to dive more specifically into the cash flow piece.
Yeah. So this is an example of a simple 4-week forecast, right? So it takes us throughout the weeks in June. So starting on the left, on the top, you have week 1 in June, right? So you would start off with, okay, the first day of June, what was your bank account balances, right? And you would plug that in there. And then what money do you expect that's going to come into the business? So for a maintenance company, this may be very easy to know because all of your maintenance clients may pay you on the first week of the month, right? And so you may know that that's $60,000 in revenue, and that the other money it's coming from maybe install projects, irrigation projects, whatever it is, that you're going to collect on during that week. Now, you may be doing the AR in your company as far as collections, like calling your clients to collect payment if they missed the payment or their invoices are overdue, or you may have an admin person that invoices and collects payments for you, right? And it's important to have a weekly meeting with this person, or if it's yourself, kind of to make sure that what the plan is on outstanding invoices. Because right now, like, I can think of one business owner that we're working with that is suffering from cash flow issues, but has $250,000 in AR. And it's like, well, come on, like, let's collect this money so that we can get money in. And it's like, the reason why I think that we're struggling with that is because we don't have like that weekly accountability check with the person that does AR to know what is the status on all my invoices that are open. I want to know, what did Mrs. Smith say? What did John say? Did they say that they were going to pay me next week? Did they say they were going to get it to me tomorrow? What is the status, so that I know when I can anticipate that money coming in? But those weekly check-ins are super important, and that accountability needs to be there. So again, for the maintenance, it's just recurring. And if you have subscription-based model and you're able to just bill their card on file and ACH, I think that's just the best way to go. Even if it's an install project and maybe they can put it on a credit card or something, and you can have them sign the form to auto debit based on the progress that you're making. It saves you money because you don't have to have like your administrative person follow up with them as much, make those phone calls. It saves money on that end, and then you don't have to chase after it either. So I know that there's that 3% fee and all this stuff, but like, what is your time worth and what is your company's time worth, right? It's probably it's a good return, especially if you don't even look at your AR weekly, right? So, or if it's your time is probably better spent calling leads, connecting with customers, stuff like that. So that's the inflow side. And then the expected outflows. What is the money that I have to pay to others? So I have my payroll, I have my vendor checks that need to go out, subcontractors, fuel, overhead, all that other stuff. And then we have your ending cash balance, which is your beginning cash plus the money that you expect to receive minus all of these expenses. That would be the ending balance for that week. See, there's a slight downturn in that first week. You started off with 245, but you're ending it with 232. So we can see if we can maybe delay some of the subcontractor checks that are going out or something like that. We can see if we can delay some of the vendor checks that maybe we can get paid. They can get paid next week, but of course we have to pay our payroll. That's something that we cannot budge on, and so on and so forth. Then week 2, we can see that, they are below their cash reserve. So every company needs to keep a cash reserve. So what does that mean? it means that you should have like a minimum bank account balance at all times, in case of an emergency. You know, you want to have a float there. And usually what that is 2 months worth of your overhead costs, the average overhead cost of your company. So if your company averages like $50,000 in overhead a month, then your buffer in the bank account should be about 100,000 of a cash reserve at a minimum, right? So 2 months of that is what you should keep. And so that this forecast will help you monitor to make sure that you never go below that cash reserve. And so this company, it looked like they were looking to make maybe a truck purchase where they had a down payment, but since they're below that threshold that they feel comfortable at, they're going to delay that purchase. Week 3, some of the cash inflows, so money coming from customer goes up. I guess your AR people got to collecting money. You held people accountable, and now you're collecting money. So we're doing good. So now I think we're going to be able to schedule that truck purchase to week 4. So that's where you see that truck purchase in there. You also have your biannual insurance payment of $20,000, and now you're back at below your threshold. So in the week 1, you should be back up, because that's when your client payments come in from your maintenance contracts, etc. But I also feel that I've seen like business owners feel reluctant to put people on like a payment schedule where they're collecting credit card information, making them sign a contract or ACH agreement. But everybody's doing it. Every single company, right, that even you probably deal with is on this model, just because like as consumers too, we don't want to deal with giving people checks, like having to write out having to log into your portal every month and pay you. Like actually that's ruining your client's experience with your company at this point, because everything else in the outside world is so automated. And if you're still in that billing model, not only are you losing money and time, you're also ruining your client experience at this point, because people actually do want to be managed in that way nowadays.
Thanks, Carla. And now we're going to move on to making some of the larger moves within your company. So making some of the investments in as smart of a way as possible. You know, looking at the financial perspective there. And here's an example. So if you're looking at a company, so the industry median typically falls around 5. It varies slightly based on service line within the green industry. Fixed asset turnover ratio, basically look at that as your revenue divided by the fixed assets in the company. So this gives you an indication in, you know, really how well those equipment and trucks are being utilized to produce top line revenue. Right, so company A might be closer to around a 3, where they're actually having to utilize a lot of trucks and a lot of equipment to generate the same revenue as company B. So company B is a 7, which basically means out of maybe 140,000 in fixed assets or roughly there, they could generate close to around $1 million in sales. So it's that, you know, $1 million revenue divided by the fixed assets, which is around 100, just to kind of give you a ballpark. So now, why is this important? Because as you're looking to allocate your funds as a business owner or a leader within the company, instead of being at company A, where now all these funds are tied up in assets, you could put yourself in a position where, okay, maybe we actually don't need to tie all of it up or as much, you know, or maybe we could start to utilize our equipment on different types of jobs where now they're being utilized a lot more, and now we're able to generate a lot more revenue and really leverage that equipment and technology well. Now we're able to generate a lot of revenue, and those other funds are now spent on other aspects of the company. So maybe marketing or sales or other areas to grow. The other side of it too, whenever you're looking at something like this, and even a lot of other financial metrics, is look at the whole picture, right? So yeah, company B might be leveraging their or I'm sorry, I should say company A might be not leveraging their equipment as well, right? And maybe they're not generating as much revenue, but their labor costs are actually very low because they actually have more equipment and more trucks, right? So, and it can be the same thing vice versa with company B. You know, they actually don't have as many fixed assets as the average company. But on the other side of it, maybe when you look at their P&L, their labor costs are a lot higher because of that, right? So it's about finding that balance that works for your company, because at the end of the day, each company optimizes in their own way. But this is one example in how you can, really look at, okay, where should we be allocating our different investments within the firm?
Yeah, and we're just looking at the fixed asset turnover ratio for a business, and the ratio wasn't favorable, right? It was because they held a lot of snow equipment during the year that wasn't utilized, and so that snow equipment's not generating any type of revenue, and the business didn't have like any contracts, like yearly contracts, right, for the snow. It's kind of, so they weren't picking up any of that revenue. So it's kind of like making that hard decisions, like, yeah, we have all this equipment that's not really producing any revenue, and I don't have any contracts in place. So depending on my return on this is truly just dependent on the climate and whether snow, will come or not. And that is way too risky for a small business owner to take on, because the return on investment and also the risk of it is not there, right? So had to make like some hard decisions in, selling those off and not providing those services anymore, because this ratio was so low and it didn't make any sense to have the money tied up in that type of investment, right?
And it's an interesting thing to think about. I think a lot of companies, I think, are a lot more comfortable if their equipment is sitting there not being used versus imagine if it was one of your employees sitting in your office and they weren't doing any work, right? So I think it's thinking about the whole company, and again, being strategic, making sure that you have, just as you're not going to put maybe a lower level employee doing management level tasks, making sure that in regard to your fixed assets and your equipment, that you're matching whatever that equipment is actually meant for with those specific projects. Because again, this could mean hundreds of thousands of dollars that you can use in other ways. There's a certain opportunity cost to that. And when you're making investment decisions in the company, larger decisions, major purchases, of course, running it by a tax professional, accounting professional, internally, if you have some of those functions as well, but creating a group of people within the company that can have their different perspectives, right? Because the finance team, certain things might always look good to them, but the other side of it, how does it impact the operations? The operations team says, oh, it's great to have all of these equipment, but at the end of the day, is that a sustainable model to be able to run and scale? So not only creating that committee, but actually taking the feedback from both sides, and then of course, following up afterwards, seeing, okay, if we make a certain purchase or investment, are we actually following through with that? Whether it's a piece of equipment or maybe it's even a software, right? Are we actually utilizing the software? Are we getting an ROI on this? Another example, again, looking at the full picture, right? So a company, landscape company, they have a lot of older equipment, and they're just not getting a great return on that. So they ended up selling 20% of that equipment and switching more to a leasing structure, right? Which is going to have an impact on the P&L, but at the same time, it freed up some of the money. So in this case, it was a considerable amount, around $400,000, which now they're able to get a better return. Now they're able to also invest that into other areas of the company. Also, within some of the decisions regarding as you're making investments into your company, it should fall into one of these categories, right? Is it something that's going to be more in the short term or more in the long term? And there's no right or wrong in regard to this. It's just having that understanding, because again, if it's something that is going to be more of a transformative, something that's going to really transform the company, then you want to come up with a timeline, right? Where you're going to check in regard to, okay, how is this rolled out? Are we seeing an impact here in regard to this? If it's more of a shorter term thing, right? Maybe adding a new skid steer. Are we seeing our margins increase? Are we seeing, are people in the field utilizing it well? Do they need better training? Do we have a good, maintenance program for it? So, always looking at, okay, are we making this more from a long-term approach or a short-term investment approach? Because you don't want to judge something that's going to be transformative based on more of a short-term timeline, because then you're not giving it its true chance to roll out. So I think it's important to have that broken out in your mind, especially as you're thinking about what you're planning to invest in moving into next year. But the other side of this too is you don't want to be in the position year after year where you're doing where if you're looking for different results, you're kind of doing the same thing, right? So it is good to let things roll out, but at the same time, have those deadlines and, have that point where, then it makes sense to maybe make a strategic change if the impact and the result is not necessarily where you want it to be. That's important as well. So many of you, so there's some of you here on the call that maybe are more towards the end of your journey within your business, right? And you're kind of thinking about, okay, what are some of those decisions in these next couple of years that I can really drive more enterprise value? But even as those of you earlier in your stages here in business, I think it's pretty interesting to think about as you build your business, really what you're creating is something that is going to ultimately one day, if you sell it, it's going to be a multiple of the earnings, right? So that's something that you should be proud of, right? And maybe on some of those tough days, it's going back to the fact that you are building something. You are building something that ultimately is going to have value one day. But the other side of it too, you want to make sure that you're building something that it's going to be worth a lot to you, right? Because it's probably like your baby, right? As you grow it, but we want that mindset to match the reality of what it's worth. We don't want you to get to the point where maybe you grow your business and because certain aspects of your company are not seen as favorable by maybe investors or other people, that you don't necessarily get to reap a lot of the benefit. So these are some of the core things that we see. Here's something which we thought was pretty interesting. I think a lot of companies know, listen, reoccurring maintenance type services, lawn care, those are going to drive typically the highest multiples. But the other side of that too is, also just as maybe some of the private equity companies or investors might see it as an opportunity, because what they can do is they can take your company and then add a maintenance division, or, they can add certain recurring aspects to it. I think looking at your company and saying, okay, where are there opportunities that I can actually take advantage of. Why do you need to wait until an investor moves in? You have the expertise, you have the all of that knowledge. And ultimately, what a lot of investors and buyers want to see is a business that outlives you, right? So, they may not even be as interested, especially if you're not going to be staying on for as long after the acquisition. They may not be interested as much in your skill set, but more in your management team, right? Who are those people that you've built up, and you've really helped them grow? And what does this actually look like? It's having a true leadership team in all aspects, in all the departments. And having some of the contingencies and, ways that different people can be cross-trained. If you have different key relationships in the community, whether it's vendors or customers, having a more standard way where you can pass that on. So all of these different items, and this can ultimately increase the value of your company. So, and then how well can you utilize technology? And again, this goes back to, why let some of the investors and private equity companies reap the benefits of this? I think try to take advantage of this first, right? You can be the one that sells for the higher multiples. You could be the one that's, gets to reap the benefits of all the hard work that you put into building it. Because the reality of it is a lot of these items are not even probably the hardest aspects, and even the hardest things that are going to happen as you grow your company. These are certain tweaks, because as you build your leadership team and you implement some of these items, this is really what can move the needle in regards to enterprise value. So specifically, how can you get technology more implemented within the company, right? So, and why do investors like this? Because it's easier to scale a company that has technology, right? You're a little bit less reliant on, what your office manager all has in her brain versus maybe having a training system, having a field management software, a CRM in place, processes, SOPs documented somewhere digitally, certain dashboards. Even going into, now there's very exciting things in regard to AI and even robotics, the autonomous mowing. So, not that you need to be in a position where you're trying to always be on the cutting edge of everything and testing different things that are not even working yet, but keeping your eyes and ears open in regard to, wow, what are we seeing that is working, across the industry, and how can we make sure to implement that, so that you can use that as, more of an advantage for your company. One of the other big things, this prevents companies from selling, and there's multiple ways to kind of tackle this, but making sure that there's not any one of your clients that makes up more than 10%, or look at a few at a time. It's, maybe 20, 25% of revenue. So making sure that you're looking at client concentration. So, ways to solve this is to, increase the amount of clients that you have at that size, or maybe acquire another company. So those are all different examples that you can utilize. But just kind of having that understanding that these are things that do impact the enterprise value as well. And we do see some questions. So Diana had mentioned, I think some of the difficulty in competing with maybe some of the smaller companies, that maybe don't have the same dollar amount overhead in regards to maybe not winning certain jobs. I think that maybe thinking about what, instead of maybe some of the positives of some of the smaller companies, because there's always going to be positive and negatives to, a smaller company, a bigger company. A smaller company may not have as large of an overhead, But the other side of it too, they don't have as many funds to invest into marketing. They don't have a brand in the community, right? Um, so I think that there's always going to be positives and negatives. One of the things to look at, and I think this is something that we typically recommend, is maybe trying to increase your marketing and sales budget. Because if you have 50 projects a year, and maybe it takes you, to go to 200 or 150 projects to actually bid for it in order to land those 50. What happens if now all of a sudden you're getting in front of more opportunities, right? You don't even have to increase your close ratio, but just because you're getting in front of more potential customers, now even if you're not getting as money because maybe some are going to your competition, that's still going to increase the sales, right? And so maybe if that turns from maybe spending 1-2% on marketing to 4 or 5%, now you're able to grow, and you could build that into your budget. You could build stuff like that into your budget, because oftentimes that's not what is going to be your limitation in regard to profitability. Is because you spent a couple percentages more on marketing. It's going to be because you didn't get 10, 15 more jobs that you were supposed to get. So I think doubling down a little bit more on marketing and branding and your sales approach. I know that there's a lot of sales experts that would probably even just say it probably has a lot to do just with that in itself. So, just a couple of recommendations there.
Yeah, and I think Diana too, you mentioned, that not having that consistent cash flow, it is hindering your company at this moment, and not getting those consistent, sales in on the install side, maybe due to outgrowing the area, the market that you're in. And you don't want to veer too far off of where you're at, because you don't want then there to be a lot of drive time, right? And then efficiencies rolling in and stuff like that. But I'm always a big proponent on the residential maintenance, because you do get paid right away, and the value of your company goes up. And I think you brought up a good point, Diana. I mean, like if you can pair up with some subcontractors to provide that maintenance service, that's a low risk way of getting into that revenue stream without a lot of like commitment. If you're going to sub it out, right? You can see how it goes. You can see if you're able to market for it in your area. You already have those contacts with the residential install projects that you already completed. You can reach back out to those people, send flyers or give them a phone call, and like I said, work with a subcontractor to see how that goes. And if you feel that this is a revenue stream that you want to take on or manage, then you can take that on and scale it. But I think that going into it in that way is risk free, and you're able to use your contacts that you already have.
Awesome, man. And if anyone has any other questions about anything in the webinar, definitely write down here in the chat. We could try to help solve some of it. Antonio said Chicago has the same thing. They work a month or two and quit, then call back in 2 months. So yeah, sometimes I think it's build that into your model. If you're not able to retain certain seasonal workers as much as you'd like, build it into your model and know what to expect. And then also try everything you can that's in your control to try to retain them as well. And this is going to so this is recorded. We're going to send this out as well tomorrow, so that way everybody, if you want to review any specific section as well.
Awesome stuff.
And like I said at the beginning, we are going to have a more of something in regard to budgeting and planning. we're probably in the next month or so. So, but everyone will see an email about that where you can register as well. We're going to have an in-depth planning session. So everyone can hit their 2026 goals.
I love that. I'm so excited for that. Cool stuff. Oh, Perry just asked, should we have 2 credit cards on file or just 1? Definitely just stick to 1. If you have 2 credit cards that you're storing, it increases the risk. But yeah, I think once the credit cards expire, you have to just get an updated form and stuff like that. But I appreciate everybody's time. I'm excited for the next webinar where we'll take a deep dive into 2026 planning and budgeting, which will be very nice. But if anybody has any questions about the financial side of your business or services that we provide, feel free to reach out to Joe here, utilizing his email, or just visit our website. But so nice seeing everybody, and I hope everybody has a nice evening here. Bye.
Bye, everybody. Hope you have a great